So, Prabha, do you mind if I ask you, do you think that we've become a little bit obsessed with trying to predict the next interest rate movement?
Yeah, that's a fair question because every economic cycle seems to become reduced to one question. So that is what RBA is going to do.
100%, right? We all sit there every quarter, every month, oh, the interest rates are going up, the interest rates are going to go down. And every headline we look at seems to reinforce that, right? We've got the market trying to predict interest rates going up, or no, we're going to get one cut or two cuts, or maybe interest rates are going to be pushed back. And it's almost as though investment success depends on getting that prediction right.
When in reality it doesn't, right? Because the Reserve Bank of Australia doesn't build portfolios, but investors do.
Yeah, and that's a really important distinction because I think investors can fall into the trap of believing, or once interest rates come down, everything's going to get easier. Maybe. But I guess what happens if they don't?
Exactly. That's why we use scenario analysis, right? Scenario analysis try to build several outcomes happening, and not because we expect one outcome, because we want to understand the consequences of several outcomes.
So let's unpack that, because we've deliberately called this the 8% question, not the 8% prediction. And there's a very important difference.
Yeah, there is. We are not suggesting lending rates will move up to 8%, right? And then we are asking a different question. So if they did, how would your portfolio respond to that kind of a situation? That is most important thing. Then how do your cash flows will be changed? And then how your structure will be resilient, and then how would whether the additional lending is possible, and then would your current structure continue supporting your long-term objectives? And those are the valuable questions regardless of where rates are going to stop.
And something that I think that sophisticated investors probably uniquely understand, right? They don't spend all their time trying to react or predict to the next move of what to do in the marketplace. They should spend more time asking, well, if I get this wrong, am I going to be okay?
Yeah, exactly. Resilience isn't about eliminating uncertainty. It's about ensuring uncertainty doesn't fundamentally change your long-term direction, the portfolio.
And I think that's a really good way of putting it, Prabha, because uncertainty isn't unusual, right? It's a normal part of building a portfolio. If you've invested over the past 20 years, you've experienced global financial crisis, you've had COVID, you've had record low interest rates, you've probably had the fastest tightening cycle in decades, we've had changes of government, we've had tax reform, and we've just had the biggest tax reform package passed down when it comes to investing in 30 years, right, with the latest changes. You've had bank policy changes as a result of that. You've now got an evolving market that comes with it. And the question really isn't whether or not the market's going to change or they're going to change. I think the question really is about whether your portfolio has been built with enough flexibility to evolve with it.
That's why the flexibility is such an important concept when we assess a portfolio. We are not simply looking at the value of the assets, right? We are looking at the structure. And the lending, the equity position, the capacity to respond if circumstances change, because the flexibility creates opportunity.
And options are incredibly valuable, right? Especially during periods like this. So, it's one of the conversations that we've probably been having more often, isn't it? Should somebody buy another property? It's not really the question. It's probably more appropriate is should they strengthen what they already have in their portfolio? Sometimes that's about improving cash flow. Sometimes it's about releasing equity to be in a liquid position. Sometimes it's actually about doing nothing. Sometimes it's about sitting on the sideline and allowing your assets to mature. They're all legitimate investment decisions.
Exactly, because every portfolio reaches different stages, right? And then there's no single answer or a cookie cutter that applies to every investor. And that's why frameworks are often more useful than predictions.
Look, I couldn't agree more to that, Prabha. It's probably where I think the industry sometimes gets distracted. Everyone's looking for certainty. They're looking at the next rate move. They're looking at the next election, the next hotspot. Where am I going to buy this amazing property that's just going to give me this amazing performance? But, long-term wealth has been created not by predicting headlines. It's usually been created by making consistently disciplined decisions year after year, right? Regardless of what the headlines happen to be.
Exactly, yeah.